A couple other areas, commodities. Commodities, the dollar, as I already mentioned, the dollar's been weakening towards the end of last year. We expect that to continue. The commodity index, the CRB, the Commodity Research Board index, rose last year to its highest level since I think about 2005. Commodities pricing has really been in the doldrums the past few years, but we saw a recovery last year as the economy started to recover. We expect that to continue commodities. Now, we're not currently investing in commodities. We used to, but the commodity market, if you're not a player in the market, if you don't want to actually buy barrels of oil or bushels of soybean or corn or a liquefied natural gas tanker full of natural gas, if you don't want to actually buy the product, the vehicles that are available to buy into the commodities market have become too speculative in my estimation and diverge from the actual reflective of what's happening in that commodity market. So we got out of commodity investing several years back. It's just there's too much money chasing too few commodities. The commodity market is very small compared to like the stock or bond market. And what happens is you have these big institutions and individual investors and people flooding money into the commodity market. And so it drives the price away from the true reality of what those commodities are trading for. So that's kind of my take on commodities. We do expect higher commodity prices, but as of this moment, we don't plan on jumping into those commodities. Same thing with gold. We expect the uptrend to continue. Gold generally has an inverse correlation to the dollar strength. So as the dollar weakens, gold tends to increase. And it's also inverse to yields. Yields go down, price of gold goes up. So we do monitor gold all the time and periodically consider investing in it. We invested in it back in the Great Recession, did very well in it, and sold it before it kind of went down. We don't like to try to time things like that, but gold is not something we want to hold in our portfolio permanently or long term. And so right now, there was probably an opportunity 2 years ago or so to buy it, but right now it is somewhat high, probably continue on the uptrend. We'll keep an eye on it, but we're not currently planning on adding it to the portfolio. But just want to let you know, we do understand gold. We watch it. We understand the investment thesis for it. It's just we don't believe that it's appropriate right now. I also wanted to address Bitcoin. And frankly, I'm really not sure what to say here other than it's a really wild ride. It's a speculative investment. It's not a stable thing. Although we saw last year a lot of institutions starting to allocate some money to Bitcoin. Some large pension funds, some large Wall Street investment banks, things like that, starting to creep in to Bitcoin. I just like to say that once again, it's something we look at. We're aware of what's going on with some of the cryptocurrencies. It currently does not meet my definition of investment, which I copied shamelessly from Benjamin Graham, who's one of the greatest investors of all time, wrote Security Analysis and some other seminal investment books, Benjamin Graham. But he defines an investment as an operation which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. And so I would put Bitcoin into that category, certainly at this point. But it is something we are interested in. I do think the blockchain technology that underlies Bitcoin has a lot of value and will become employed in a lot of different other areas. But we're not ready on a wholesale basis to start investing people in Bitcoin. So kind of putting this all together, what are the portfolio implications? So once again, some themes here: low returns or lower returns on the equity, absolute low returns on the fixed income side. We're watching inflation and yields. If inflation starts to creep up a lot or yields start to creep up a lot, we may need to reevaluate the themes. We don't see high interest rates or high inflation anytime soon. We also think that some of the post-recessionary themes, which basically was US large cap technology, dominance in the market, we do think that is going to start to reverse itself. Volatility has receded, and we think that will stay low, which is good for returns. As I've mentioned already, fundamentally, financial markets are a supply and demand. More money chasing fewer stocks, price goes up. If everybody's doing an IPO, new companies flooding the market, and there's not a lot of money, prices go down. It's supply and demand. And we did see last year a lot of money exit the market that is still not returned for coronavirus, people panicking over coronavirus and exiting financial markets. A lot of that cash is still on the sidelines. And so I think you'll see that come into play and help support higher prices in 2021. Okay, so once again, to summarize some of the tilts or overweight, we're not going to go crazy with this stuff. We don't recommend that you do too, but understanding, we think there's going to be a little bit more return available in the foreign markets, specifically emerging market. We also think smaller companies will benefit in 21 at the expense of larger companies. And probably towards the end of the year, you're going to see value, especially as the Biden administration, some of those policies come into play. We'll talk about that in just a second. We also think REITs will be a beneficiary. They were the only sector last year to have a negative return. People kind of panicked over real estate. For those of you that invest with us in private real estate, as you know, we've done extremely well in that sector. Expect that to continue, but the public REITs get a little bit more of the panic factor of investors, buying and selling, where the private market, it's more long-term money. So we expect those REITs to recover this year. Big tech, feel like it's due for a haircut. You got the regulatory environment as well, issues that could possibly rear its head this year. So anyway, those are some tilts that we'll look for. On the fixed income side, overweight, tilt towards high yield, the credit, as opposed to just pure treasuries. Kind of neutral on term, short versus long. We tend to stay in the shorter end of the curve. We're also continuing our allocation of tips, and certainly fixed income over cash. There's almost no reason to hold cash. High quality, short-term bonds, treasuries, at least you get some return out of that. We do see some elevated risks in the second half of the year if valuations continue to go up. And as I said, if we start to see yields creep up and inflations creep up. A couple other themes, the COVID recovery, Biden agenda, and what I call all things green. So those are three themes that we think will continue to play out in 2021. Of course, the COVID recovery, there's still industries, leisure, travel, entertainment, restaurants. We think those will recover this year as the economy goes back to full productivity. So there may be some opportunities in those arenas. Green energy, actually maybe overbought, solar, wind, battery, those type of things, Tesla. But there's still some opportunity in that. You've got massive government intervention in these sectors, which is why it makes it a little bit more difficult to evaluate, because it's not pure market forces driving those sectors. But it's certainly taking place. I know out here where we live, I mean, honestly, it's kind of sad. There's some giant farms near where I live that I drive through to get to some property that I own. And you drive for about 10 minutes and all this farmland is now these giant solar farms. And so investing in that is going to continue. Offshore wind here in North Carolina, they're debating, about building these giant windmills offshore. Once again, that's a theme, and it's taking place, and it will continue to take place. We don't want to completely destroy our existing energy sources, but you will continue to see these green energy sources replace certainly coal is the initial thing that will probably go away. Oil probably reduce somewhat next. natural gas, which is a fairly clean energy source. I think you'll continue to see it. We just can't run the globe on solar panels yet. Not the way that we're doing it now. It's kind of a sidebar, but I believe the real solution to this is what I call micro energy generation. If you turned rooftops, asphalt, those type of things into energy producing, as opposed to these massive central plants for solar, I think that would be a much smarter way to go. Maybe more expensive in the short term, but longer term, I think that's going to be a much better solution than these massive projects. But anyway, that's off the subject. Okay, and the last theme I want to talk about is the Biden administration promising to spend massive amounts of money, not only on COVID relief once we get through that, but infrastructure, healthcare, capital goods, as I already mentioned, energy. So things like those type of industries, industrial, healthcare, energy, I think you'll see as a beneficiary of the Biden administration policies. Kind of on a side note, there's a lot of states that are in trouble now with their budgets. Coronavirus has hit them pretty hard. Tax revenues down, all the sorts of things. And I think you're going to see several of them have already started turning to cannabis, as well as sports betting is another really interesting sort of micro industry that I think you'll see some growth in as states, unlike the federal government, states obviously can't print their own money. And so I think you'll see those two industries, they're going to turn to those to try to siphon off some tax money. But that's kind of a side little theme. Okay, so putting it all together here in 2021, basic investing principles that have been around for hundreds of years are still intact. They haven't changed because of the pandemic. Stocks offer a higher return than bonds, but we still believe in diversification into those bonds for stability, and you get the growth out of the stock market. We expect lower returns going forward for both stocks and bonds. We expect tilts both in stocks and bonds to add a marginal degree of extra return, but we still don't believe in trying to guess the macroeconomic environment or which sectors are going to do best. We don't recommend making wild changes to one's portfolio, because while it may work out a few times, you may get it right a few times. The 75 to 95% of the time that you're wrong or slightly incorrect, it can be really harmful to your portfolio. So we like just a little bit of tilt, but there's nothing in 2021 that we see that warrants making crazy changes to a good, solid investment strategy. Okay, so next time, our next video, I'm going to be tackling the beast of tax reform. There's a lot of tax changes on the horizon, and so we'll be tackling that in our next video. So I hope you can join us then. Until then, I hope you have a great day and a great rest of your week.